Good afternoon and welcome to our overview of the Ottawa commercial real estate market. Today's presentation is being brought to you by BOMA and the Ottawa Board of Trade. My name is Sean Hamilton and I'm the president of BOMA Ottawa and will serve as your moderator today. Our goal over the next hour is to look at four distinct segments of the local real estate economy: retail, industrial, office, and investment, to try and make sense of where things stand right now, as well as how both occupiers and landlords can position themselves in a positive light despite current conditions. 2020 will be remembered for many things, but most interesting is how certain recent trends have been accelerated, benefiting some sectors of commercial real estate, while other asset classes are facing more drastic and uncertain shifts, demonstrating that the COVID pandemic means different things to different asset classes. To examine what has transpired and what lays ahead, we have enlisted local experts to discuss the status of the Ottawa office, retail, and industrial sectors, as well as to look at the quality of commercial real estate in Ottawa as an investment opportunity. BOMA would like to thank the Ottawa Board of Trade for being our sponsorship partner, as well as the Property Management Institute of Canada for producing today's broadcast. We hope you enjoy and take something away from today's presentation. COVID-19 has placed a great strain on our office markets, as all office occupants have in some form or another had to learn to work remotely almost overnight, ready or not. The impact has affected both our private and public sector tenants, and it remains to be seen if, how, and when these groups will return to work in the buildings they have vacated. Opinions range from the traditional to the extreme, and what the future of work looks like is in its early stages of being redefined and can only be truly tested once this pandemic is over. The most negative projections suggest that many businesses will never go back to the office and tenants will start to hand back space to landlords, and we've seen evidence of an increase in sublease activity, which is a normal occurrence during uncertain times. To get a sense of where things can shake out, we've sought out two experts on the Ottawa office market to look back and to look forward. Warren Wilkinson is the managing director of Colliers International, a global brokerage and advisory firm servicing both landlord and tenant communities. And Alan Desmarais is the executive vice president and broker of record for Cushman & Wakefield Ottawa. Alan is a senior executive within Ottawa's commercial real estate industry, advising both landlords and tenants alike. So Alan, I'm going to kick off with you. Help us make sense of this. Is the office dead, or is it just going through some changes?
Thank you, Sean. Definitely the office is not dead. That's the good news. 2020 was a very difficult year, obviously. We've seen a lot of unprecedented conditions hit the market, and tenants and landlords both have had to adapt to the way things have gone over the past year. And having to shut down, being mandated to shut down by the government for extended periods of time, have forced tenants and landlords alike to adapt. It's forced tenants to embrace technology and get people to work from home more than ever before. And so certainly we're seeing tenants embrace technology. We're seeing less office space being used at the moment, but we don't know if that's going to be permanent or if it's going to be a temporary thing. For some, it's working very well, and for others, it is not working very well at all. So in your introductory, you mentioned, everyone's adjusting to the new times, and we don't know what the future is going to be. But we certainly know that the office sector is not dead. It's just going through some changes and going to adapt to the new normal that we are trying to figure out what that's going to be.
Yeah. Now, Warren, going to you, commercial real estate and the leasing market has never been famous for being flexible. Are you finding that there are challenges or that there are new approaches being taken as it results or as it pertains to the structure of commercial real estate deals? What are you seeing on that front from both the landlord and tenant perspective?
Thanks a lot, Sean. Flexibility and change within the leasing market right now are quite frankly, they're paramount. They're an absolute necessity when considering your space needs. And I think it really starts at any leadership position. Leaders, whether they're on the landlord side or the tenant side, must be humble, open-minded, and listening to their employees' needs. The culture within the office is really going to drive how we return back into the office. It's based on a fundamental trust in the company's executives to make the right decisions, the company's missions, and their colleagues. So within the office space, and how do you foster that trust within an organization if it's not within the office on a daily basis? As it relates to the landlord, how do they facilitate that flexibility on the tenant side when there's so much uncertainty? Is it through shorter lease terms, which is what we're seeing requested from a lot of our tenant user groups, whether 1 to 3 years as opposed to the traditional 5 to 10 years? Are landlords being more open to rights of termination, rights of first offer, rights of first refusal, other elements that have been traditionally looked upon by the landlord community as deal breakers and non-starters? So yes, the leadership in both the tenant community and the landlord community really is being based on being nimble and flexible when they're having their conversations with their groups.
So in 2008, Alan, when we went through the global financial crisis, we found that lease terms became shorter, there was flexibility being built in, yet we returned back to normal. And I suppose the jury's still out on what's going to happen post-pandemic. But do you sense that this might be a permanent shift? And I invite you to sort of comment on other strategies that companies are invoking more as it relates to how do they make a decision regarding what the space needs are versus what their lease terms are. And should companies be making always decisions today, or should they be waiting to make long-term structural changes?
Mm-hmm. Well, we're certainly seeing tenants press pause for on their business decisions, their leasing decisions for the moment, because a lot of them are trying to figure out what their new needs are going to be, how they're going to be working moving forward. Are they going to be working from home more? Are they going to be needing more space? Are they going to be needing less space? So certainly we're seeing tenants press pause. Those that are able to forecast their needs more confidently are going to have an opportunity to take advantage of the opportunities that are out there. As you mentioned in your intro, there's more sublease space on the market right now, and that will provide some opportunities for tenants to take advantage of those situations. And flexibility is key, as Warren mentioned. Landlords and tenants are in a partnership together. They're business partners essentially, and when they need help, they need to help each other out. So obviously we're seeing flexibility. We're encouraging our clients, tenants and landlords, to have open discussions about their situations to find out where the solutions are that will help them both prosper together and navigate this difficult time. Is it going to be a year or 2 or 3 moving forward where they will have to maintain flexibility? It's probably going to be a little while, but it's not going to be forever. It's certainly a difficult situation, but as you mentioned in 2008 and in other recessions or other difficult times before that, Ottawa has bounced back, and we do have a strong economy here, and we are a little bit less susceptible to major spikes and major dips. However, this is an unprecedented time, and Ottawa will bounce back, and tenants and landlords just need to work together to find those solutions that will help them get through the situation.
You bring an interesting point that I'm going to shift to Warren on about, avoiding major spikes and major troughs. Certainly our Canada market, which is, our high technology hub, whenever there are good times, it's been great times, and whenever it's been hard times, has been really hard times. But it seems this time around that the pain points are being seen in the downtown more than in the suburbs. Warren, do you want to comment if that's a positive or negative, or really what does that mean for the layout of Ottawa in terms of how downtown is responding versus the suburbs?
Thanks, Sean. There's quite a bit to unpack there. So one thing that we enjoy doing here is, pitting one market against the other, whether it's office against industrial, whether it's downtown versus the suburbs, whether, West is best. You're talking to two Canada boys right now, so I think we would take that position. Um, Often with suburbs, they're always looked upon as secondary to the downtown core, and now the roles are reversed. We're not seeing nearly as much pain in the suburbs as we are seeing within the downtown core, and that's likely a result of whether or not anybody on this call has ever had to take a bus from Orleans to Canada North. The reality is that the suburbs aren't suffering as much because a lot of the product out there is relatively, pandemic neutral, pandemic proof, if you will. We're talking about low rise, multi-tenant flex office or office space that doesn't provide an opportunity for, communicable diseases to spread within a lobby or an elevator. So that makes it a little bit more pliable for leaders to suggest to their staff to come back into the office where it's just as safe as you would be at your home or at Costco or the superstore. Also, parking is in abundance within the suburban markets, where downtown, certainly there's an argument to be made about abundancy, but there's still a cost associated to that. So the suburbs seem to be, I guess, the belle of the ball right now in comparison to the downtown market, where you can shoot a cannon down Albert Street and not hit a single soul at rush hour. So yes, they are faring better just based on their position as it relates to what we're currently going through. Do I think that's going to continue? That's a federal government question. Al, I'd love to hear your thoughts on it.
Well, I was just going to mention that. Thanks, Warren. Obviously, downtown has a major presence for federal government workers, and with the federal government mandating everyone to work from home, I think we have about 150,000 federal government employees in Ottawa, and I think about 4,000 or 5,000 of them are at the office these days as essential workers. A majority of those workers are in the downtown core. So it's a fairly unique situation in Ottawa where half of our office space downtown is occupied by federal government workers, and they're all at home. So that further provides an environment downtown where it seems like there aren't very many people, because there aren't. And in the suburbs, in Canada, for example, the technology world is predominant there, and the technology world has fared well in this pandemic in general. Not everybody, but in general, the technology world has fared well because there's an increased need for technology. And as Warren mentioned, people can park there. They're in smaller buildings. They're in single story, two-floor buildings, and they don't have to encounter 10 people in an elevator. Not that that's happening in the town either, but it makes them more comfortable to go to work in the suburbs in smaller buildings for the time being. Once we see the government come back to downtown, we're going to see a revival, I believe, of the downtown core in terms of having restaurants being more active. All the services and the retail services are going to be more active, and people are going to feel more comfortable coming downtown. The federal government is going to be a huge part of that, obviously. Sure. We don't know what's going to happen yet. We thought it was going to happen this spring or this summer, and that seems to have been pushed, and it might be, I think, into early next year. Who knows? Maybe it'll be tied to the vaccination rates. Once everyone's vaccinated, maybe that's what they'll work with in terms of getting the federal workers to come.
Just mindful of time and wanting to give the last word to the two of you. We've got 2.5 minutes left. Maybe if I can start with Warren for a minute, and then Alan, finish with you for a minute. Warren, what advice would you have for a tenant and a landlord right now? And I'm talking 30,000 feet, but what are the hot buttons you would be advising landlords and tenants alike right now? And then Alan, to you, the exact same question.
So 2 things for tenants. Look to opportunities to understand your workplace solutions. So how you use your space, look to experts in order to advise you on that. I'm certain there'll be tons on this call, as there is through your guests here, Sean. Also pay attention to sentiment surveys. Go to Ipsos, go to Nanos, take a look at the sentiment surveys and find out where other companies of similar ilk are expressing their concerns and put pushing forward. At the end of the day, fortune favors the bold, so there are opportunities if you're looking to lock in longer term. There are opportunities out there for you now to take advantage of a relatively, I guess, a softer or a weaker market. And for landlords, I would say continue to work with your tenant partnership. In addition to that, can you teach an old building new tricks? Can you teach a new building new tricks? Look to how the desires and the needs of your tenants and the occupiers and the users of the space may influence the operation of your building and how you can take advantage of that, either through cost savings or even stretching out the life of some of the capex that you were expecting to spend in a shorter time frame, maybe pushing it down the road for HVAC. So HVAC and other items.
Great. Alan?
Thanks, Sean. I think, again, the key is flexibility. Understand what your needs are moving forward. And obviously, a lot of tenants are trying to figure that out right now. So that's why we're seeing shorter term renewals, 1 year, 2 year, 3 year, instead of the 10-year expansion plans going forward and new buildings and such that may have been contemplated 8 months, 10 months ago or a year ago. I think the key is to engage with your landlords in discussions. We're talking to tenants and landlords every single day, and our goal is to try to find solutions that work for both sides, that where they can both prosper and continue in business together as partners. So I think, again, the key is flexibility. Understand that there may be some opportunities for long-term deals that are there if the tenants know what they really need moving forward. And if they're still trying to figure things out, the landlords need to be able to accommodate that. Maybe that means a shorter term deal, but the landlord gets to maintain a decent rental rate moving forward because they're being flexible on both sides. So it have to be flexible and understand that the landlords need them, and the landlords have to be flexible and understand that the tenants need them as well.
Wonderful. Gents, we're out of time. We could talk about this all day, but I'm grateful for your insights. Thank you very much. And let's look forward to strong recovery in the city. But thanks again. I appreciate your input.
Thanks, Sean.
Thank you, Sean.
I don't think we could find any sector of our economy more negatively impacted by COVID-19 than the retail sector. While some of our largest retailers and pharmacies were allowed to remain open due to their critical importance, many more small retailers were not, or they were burdened with very limiting conditions, making opening in some cases difficult to the point of being impractical. Many were able to make up some ground by offering online purchasing combined with door-to-door delivery or curbside pickup as they tried to compete with international giants like Amazon. At its beginning, sales in the retail sector plummeted 30% nationally, and even though by year end they bounced back somewhat, the impacts of COVID-19 had different impacts on the different segments of the retail economy. Certainly on the local street front level, many local businesses who rely on people traffic are feeling the most pain of any particular group. To discuss what's next for the retail sector, we've invited two experts. Richard Getz, who we brought out of retirement, remains one of Ottawa's most senior retail real estate partners with over 40-year career and over 1,000 transactions in Ottawa shopping center industry. And Candice Lerner-Fry, who's the first vice president at Marcus Millichap, is a 15-year retail veteran who is known for her expertise in both retail leasing in the National Capital Region and Eastern Ontario, dealing with both national and local clientele. Richard, I'd like to open up with you. What's happening? Is retail all being affected across the board equally? Are there some positives, some more negatives? Walk us through.
Well, first, Sean, thank you for the kind introduction. And as you indicated, to say that retail is in disarray would be an understatement. However, it really varies by class, by location, and by retail category. You've got urban versus suburban. You've got enclosed malls versus open air centers. You've got the downtown streets and office buildings. And from the retail spectrum, you've got everything from essential services retail, which is thriving, as you stated, to obviously the health club industry and the restaurant industry, which is anything but. And so I would say in our market, it is in fact there is a variation right across the board. There is no normal, but there are areas that are far worse hit than others.
Okay, now Candace, bringing you in here, with this uncertainty, often that can create opportunities. What are you seeing in terms of your day-to-day, in terms of bright spots or dark spots in the retail world as you know it?
Thank you, Sean. For sure, retailers and landlords had to think on their feet when we got shut down last year in 2020, March 2020, and they had to rethink the way of doing business and offering for retailers that did not have an online platform, curbside pickup. So it was really landlords and tenants working together and getting, rethinking of what kind of, how to offer customers the way of doing business. So it was really quick thinking. I think that we turned down to online shopping fairly quickly. Even generations that never was ever going onto the internet on the computers had to, get used to it and get help people from, being able to shop online.
So to both of you, I'll put, maybe Richard, you answer first. Is online now a mandatory requirement for retail business, regardless of the product you're selling or the aspect you're in?
Yeah, Sean, as Candace just stated, those that never would have dreamed to have shopped online were forced to, and they now do it as a regular course of business. So the message to the retail community is, your platform needs to be in-store and online. It's not going to replace in-store. I think both Candace and I think in-store is going to come back for a lot of reasons, but yes, you must have a dual platform now, absolutely.
Yeah, and Candace, are you seeing, you'd mentioned you need this online platform, but are retailers adapting, or are there still those who are slow to adapt, and are they at risk?
The ones that are not adapting are the ones that we're seeing that are, closing for good, that are not able to survive. None of the retailers in 2020 and beginning of 2021 will be able to survive or have survived without having an online platform.
Interesting. Okay. And are you finding this goes beyond commercial real estate, but I mean, that's a technology issue. How are you finding that retailers are equipped to deal with a technology issue? Is it a challenge, or is it something there that's reasonably easy to achieve?
Well, it's a challenge for the independents for sure.
Yeah.
But, there's lots of support. The fact that someone of my demographic is able to call into this broadcast and do it on his own is a testament to the fact that anybody can do it. So.
Yeah. Candace, we're seeing in a lot of other markets that leases are becoming more flexible and clauses are changing. Are you seeing changes in the structure of leases impacting the retail world?
The famous COVID language that we have been trying to negotiate and getting landlords and tenants, I guess their heads wrapped around it. It's not been easy, at the beginning I remember that we were reading force majeure language and going and discussing with insurance if it would cover some of these, shutdowns, and but really every retailer and landlords fighting against the COVID language and rent abatement, and the tenants fighting for rent abatement in case of pandemic or future pandemic or even current pandemic. So.
Yeah. And Richard, in the major enclosed malls, in prepping for this, we covered this, there were some serious expenses that were being incurred by the retailers in terms of rent. How is that being dealt with now, or what strategies are you seeing landlords and tenants use to sort of get through this period of uncertainty?
Well, the reality, Sean, is that a tenant can only pay so much rent based on their sales. And so what the majority of enclosed mall landlords have had to do, and I believe downtown office landlords with retail components and in some cases street fronts, are going to have to go to a hybrid of gross rents or percentage rents with breakpoints where the tenant's rent is normalized above certain sales and it's 7 or 8% below certain sales. Otherwise, the tenants won't be able to survive. Their sales in enclosed malls in many cases have dropped by 75 or 80%. They obviously can't pay enclosed mall rental rates at that, and the same with downtown offices. Your ground floor amenities to your building can't pay you $100 gross or $80 gross anymore. They can pay you a percentage of what they're making.
Yeah, and there's been a lot of talk in the news about the topic of evictions. What would you counsel a landlord who has a tenant that's not able to pay rent due to no fault of their own on, do you keep the tenant? Do you not keep the tenant? What strategy makes the most sense?
Well,
Go ahead,
Either of you can answer. Both of you can answer.
It's much more expensive to release a space, so landlords and tenants need to work together to find a way of making this work. What I've been telling my tenants or my landlords is that they need to work together. People often forget that landlords are also small businesses and they have mortgages to pay, and tenants just can't pay the big rents that we negotiated pre-COVID. So they need to work together. They need to find a way, because paying my commission and the lawyers to evict and release is just it's too expensive.
Just to get back where you were pre-pandemic, right? It's a lot of work.
If you're a landlord and you can help, please help. If you're a tenant and you don't need help, don't ask for it. Don't be part of the problem, be part of the solution.
Got it. Are there any segments of retail that are extremely popular? I was surprised, in speaking with people, that it sounds like certain types of storefronts are in high demand, which to me was counterintuitive given what I was hearing in retail. But is there a side of retail, and I mean, not the warehousing side of things, but on the street front, that is popular? Candace, I'll start with you.
Restaurants that are already fit up and that are in good condition are very popular, and any good shape units that can be converted to cannabis, and a bit more cannabis.
All right.
Yes.
Who would have thought? Richard, are you seeing anything also as embers of opportunity?
Yes, and as it relates to cannabis, did you ever think that smoking up at a family gathering over the holidays and the illegal part of it would be the family gathering? So, no, but yes, no, Candace is correct. If you've got good retail and your space is built out, and unfortunately people have had to close, there are the good retailers are seeing that as an opportunity. They can get into space with very low capital costs and continue to grow, and that is being evidenced, especially in our market, which is as stable as it gets. Let's be frank. It can't be any better than the Ottawa market.
It's difficult for retailers of some type of to be able to get financing. So, if they don't have to put a lot of money into renovations, it is these spaces that are going much quicker than the spaces that require a huge fit up.
Gotcha. Now, just mindful, we've only got 2 minutes remaining. I'm going to pose the same question to the both of you, just recognizing that many local tenants in the retail segment seem to be the ones who are struggling the most. What advice or what strategies, or how would you advise a struggling retail tenant to deal with their landlord, and at what point is enough? And at the risk of being controversial, should someone step away from their business? Candace, I'll start with you.
We need to, going to answer the question, but we need to think outside of, life after COVID. And I think that retail is always reinventing itself. So, tenants and landlords need to try to survive until COVID is, we get vaccinated and the world reopens. And, when the world is going to reopen, I don't think that humans will want to be at home. So I think that retail is going to thrive again. So it's just figuring out a way of being able to survive until then. So again, reinventing your business, having an online platform, trying to pay landlords as much possible rent as possible without, shutting your doors.
Okay.
And again,
Richard,
Sean,
final word to you.
and again, it's for both the landlord and the tenant, it's cheaper to keep a tenant than it is to replace them. So if the tenant is trying their best to make it, it behooves the landlords to work with them if they can. Obviously, that's not going to be the case in every circumstance. Businesses are closing, and many have closed and will continue to do so. But if everybody works together, you can minimize that outcome.
Perfect. So communication and cooperation sound like key words and key strategies. So anyways, Candace, Richard, thank you so much. I really appreciate that. Clearly, this is a fluid situation that we hope ends soon so that many of our small operators and even much loved retailers can get back to normal, so we can all get back to our conspicuous consumption as we did in the past. But thank you for joining us, and appreciate your insights.
Thanks for having us.
Thank you, Sean.
The impact of COVID-19 wasn't the same across all sectors of the commercial real estate industry. As in-store retail was suffering through one of its worst years ever, CBRE recently reported that the national availability rate in the industrial market decreased to 3.3%, resulting in 10.4 million square feet of positive absorption in the final quarter of 2020. Even within a pandemic and related economic downturn, 2020 saw over 23 million square feet of new industrial product come onto the market nationally, a record for a single year. COVID-19 and the ensuing stay-at-home measures dramatically accelerated e-commerce sales in Canada, necessitating occupiers to develop more complex logistics networks across the country. The question to consider is Ottawa positioned to take advantage of this opportunity? Now, to answer this question, we've invited two local experts, each with unique perspectives. First, Steve Piercy is joining us. He's the Vice President at CBRE, who represents both national and local tenants and landlords with their Ottawa requirements. And Ryan Semple, who's the Director of Business Development for Avenue 31, an active local development company with land holdings in excess of 800 acres, poised to service growth in Eastern Ontario. Steve, I'm going to open with you, quoting from a Cushman and Wakefield report that came out this week saying that Ottawa's growth as a percentage of its own inventory is the greatest in North America. What are you seeing as it relates to Ottawa's industrial real estate growth, and what does this mean for us going forward?
Yeah, thanks, Sean. Thanks for having me on. I guess my first reaction to that last quote you'd said is that it's probably a little bit misleading. If you know the market here well in Ottawa, you would know that most, if not all, the supply and absorption that's happened within that stat is because of two large buildings that Amazon has built. That being said, coincidentally, it's not wrong in what it's showing, the fact that Ottawa is exploding from an industrial real estate perspective, as are most markets across North America, frankly. Over the last 12 months, we've certainly seen a drastic uptick in activity of all users. And what's interesting from my perspective is actually the size of users have gone up as well. Ottawa has traditionally been a very small market, 5 to 10,000 square feet, and we're certainly seeing larger users starting to look at Ottawa and on a more frequent basis.
So Ryan, shifting to you, just because your group has clearly positioned itself with land to take advantage of industrial growth. What are the tea leaves saying to you in terms of Ottawa and how it's positioned?
Thank you, Sean. To answer that question, I would say that over the last 6 months, a new trend has happened in that we're getting calls. Our company out of Toronto, Steve, calls me regularly. Brokers out of Montreal are calling, looking for large sites for larger users, to Steve's point. And fortunately for us, we have sites that we've been working on for a while, hoping to break ground this summer for our first building. And if this building would be built today, we believe that it would be fully leased. So there is really the current stock of the industrial market in Ottawa is a little bit older, and there's a need for larger buildings with higher ceiling heights to focus more on the cubic footprint and take advantage of these rates that are going up. And so effectively everything's increasing in terms of demand. It's really a question of economics. There's a limited supply.
You're seeing an influx of users come from out of the city, whereas a lot of the time our industrial tenant mix was more local. You're seeing more national and North American players.
We are, and we believe that Ottawa is now being viewed as a regional distribution area. It's growing. It's really exciting. We're very excited about this. There's more opportunity in Ottawa. There's more businesses coming to Ottawa, and as a result, these larger companies want to position themselves here. And
Steve, just over to you, sort of building off of what Ryan said. I mean, looking at Ottawa's inventory, we have one of the older inventories in the city, or in the country, I mean, with some of the highest rental rates in the city. What's preventing us from growing? And how does the market look long term? If I'm a local warehouse user with 10,000 square feet, what does my world look like? Should I be looking for continued rising rates, or is there some relief for me?
Yeah, good question. I mean, Ottawa has really not had any significant supply growth in the last five to 10 years. And that's certainly caused added pressure to already the change in, the retail, the e-commerce transition here. But we already had that supply pressure going into this, this new change. So I think that's compounding the issue, Sean. So from a tenant perspective, you're really faced with limited options. You're either renewing a place that rents 10, 20, 30% higher than maybe when you did your original deal, or you're forced to look for other options. And, when the supply is this low, if you go to the options, I mean, right now, if you're any group over 5,000 square feet and you do a search, whether it's 10,000, 20,000, 50,000 square feet, you probably have less than 10 options across the whole city to look at. And when you dive into those options further, you may have even less because most of them may not even meet your requirements. As Ryan said, we have a lot of old supply, and if you're looking for high ceilings, multiple docks, et cetera, you may be left with one or two options to choose from as an opportunity to move.
Interesting. So all sizes, you're seeing that same crunch. It's not like if you're 10,000 square feet, you've got a lot of options, and if you're 100, you have few. It's really all users have very few options.
Correct. Yeah, correct. And listen, I think again, as mentioned previously, I think there's going to be more opportunity for users to grow in size here. I don't see developers building any small bay buildings. I think the only way to get scale is to build larger buildings as well. So I think the demand crunch on both the small market and the large users is going to exist until we get some more buildings like Ryan built here in Ottawa.
Interesting. Ryan, what a new industrial user wants and how that aligns with what our existing inventory is in Ottawa, and not so much your new proposed developments, but I'm wanting to sort of see if there's a disconnect between what Ottawa's supply as it stands now has to offer versus what a new, larger industrial user is looking for. Can you give us a sense of what that is?
Sure. Well, right off the bat, when you're talking about a larger building, you can talk about cost efficiencies, which is important. And these larger users are typically in logistics and supply chain. If you're talking about a distribution center, and the costs of transport is very high, much higher than real estate costs. And what that means is they need access and they need a strategic location. And they're looking for areas near 400 series highways so that they can quickly access the on and off ramps, whether they're going eastbound in and out of the cities. And the further away they are from these highways, the more costs. And we don't have too many of these sites in Ottawa like this. So, the land supply is low.
Access to transportation as well as size are two of the biggest fundamental differences that you're seeing right now. Never mind power, ceiling height, but certainly just the old real estate expression, location, location, location.
Exactly. Access to the highways, higher ceiling heights, more efficiencies, visibility. I'd say these are the three main points for these new tenants.
Gotcha. Now, Steve, you mentioned the tightness of the market, whether it be across all borders. And I know I've been very public, going on record stating that the Ottawa's official plan doesn't do enough to sort of provide, land options for large users. Are you seeing people's geography open up? In other words, are people going to be looking outside of Ottawa? Do you see the 401 corridor or places like Castleman, Van Cleek Hill, heck, even Arnprior? Are you seeing an opening up of geography, or will people still stay in Ottawa?
Yeah, good question. So I think what Ottawa is faced with is a risk factor here moving forward if we don't get more lands and more areas where we can increase supply in the city, help lower other overall costs for putting some of these developments in place. I mean, if we look at some other cities that are in similar positions as Ottawa, take Calgary for example. Calgary right now is benefiting from an incredibly tight supply and rapidly rising rates in Vancouver. And a lot of users now are looking to Calgary as an alternative location. And yes, there's some geographical and transportation advantages in Calgary, but Ottawa should still see a lot of that, I'm going to call it overflow, coming out of Toronto and Montreal, as Calgary is seeing. And one of the problems that we're seeing is when Toronto or Montreal is calling Ottawa, they're finding out that our rates and our lack of opportunity here in Ottawa is the same as in Toronto and Montreal. And my worry is that trend tends to continue, and we don't have more supply and more economically priced product, that they may start looking at other places like Cornwall or along the 401 where land is readily available, development costs are lower, and to Ryan's point, there's still an opportunity to be on an established highway. So, there's labor considerations down there, which Ottawa doesn't have. But, for the most part, people who need to be in Ottawa are going to be in Ottawa. But my worry is long term, if there's not more economical options, that maybe they look elsewhere.
Yeah. Now, Ryan, for you guys, that positive pressure, I think, would bode well in the short term if you had well-situated land that you could build on. Taking your stuff out of the mix, assuming that you have great success and it gets leased out, do you see Ottawa sort of limiting out by virtue of land for other large-scale developments, or do you think that Ottawa's in a good position?
That's a challenging question, Sean. I think that based on the speed at which e-commerce is changing our markets, it's hard to predict what that's going to look like in 2 or 3 years. Based on how quickly it's happening, there's a good chance that we won't anticipate and have enough land. So we expect our sites to fill up relatively quickly. It's the planning phases are a little long. Once the shovel's in the ground, it becomes a reality, and sites lease up. Depending on how the city expands, I think they'll be aware. They're obviously interested in growth of the city, jobs, positive things. So there'll be a lot of balls in the air.
But what I'm hearing from you is demand is robust and strong.
Very much so. Very much so.
So, guys, we've got a minute and a half left, and just want you to be brief on this. I'm going to ask you two different questions. Steve, for you, what advice would you have for a tenant who has a lease renewal coming up right now? And Ryan, for you, what do you see are the greatest opportunities for Ottawa industrial right now, recognizing you're both different sides of the spectrum? So Steve, if I can start with you.
Well, I guess obviously my first recommendation is seek out a professional, shameless plug. But that being said, I think it is important to have access to knowledge of what's actually happening out there in the market, know what other deals are being done at, and then arm yourself. Once you're armed with that information, then use it to make the best choice available. And for me right now, depending on the tenant size, that's putting yourself in a position where you're locking in rates on the short and long term, and protecting your business from a financial standpoint in that sense, and ensuring you have a viable location here in Ottawa for the short and long term.
Okay. Sure. Do you see the market softening in the short term? In other words, for a user who's saying, I'm going to wait a year and hopefully rents will go down because of COVID, do you see rents going down, staying the same, or going up?
I see them continuing to rise. I don't believe COVID has had much of an effect on the industrial side of things at all. I believe we experienced a somewhat soft experience on the small bay industrial during the first 6 months of the pandemic, but all that has subsided. All cylinders are firing at all fully right now, and I don't see that subsiding for the next little while. And frankly, if tenants wait 2-3 years to lock in long term, they could be looking at $14 to $16 net rents, maybe in the foreseeable future, if we don't unlock some supply.
I know here, because industrial, I think, is one of the bright lights for Ottawa. What do you see as the opportunities for the city in the next, short to medium term?
We will now have access to different companies. They want to relocate in Ottawa, and that means growth for the city. So I think that's fantastic. In terms of what impact does it have on the industrial market, I think that we need some new product, and we need it quickly. If we don't get some new product to market, the prices are going to continue to rise, as Steve said, and tenants will have limited options, and I don't think that's economically viable for everyone. We want to create balance. So it's important to have new buildings with these higher ceiling heights to provide areas for these users to come to reposition themselves here.
And I'm hearing from you, which I think is one of the most exciting things I've heard, is we're on a bigger radar screen as a city than we have been in the past, which means more companies will know about us, know our fundamentals, and want to come here. Am I correct?
That's correct. Ottawa has access to people. It has access to talent. It's a great location for these companies to set up shop.
Awesome. Guys, I've got to end it there. I could talk all day about industrial because it really is an exciting asset class for the city. But thank you both for joining us. And, we look forward to seeing how the things play out over the course of the short to midterm. So thank you very much.
Thank you, Sean.
As much as we look at what happened in 2020 as a result of the pandemic and forecast how we think that will affect current leases, an important question to ask is, how does Ottawa look as an investment opportunity? Like much of business, commercial real estate investment volumes face circumstances not previously seen, resulting in national investment volumes declining compared to 2019. Canadian volumes did do better than some countries, and in fact, some suggest that investment activity in Canada accelerated as 2020 progressed, rising each month from the middle of the year. Canada's fourth quarter investment activity was a total of $13.6 billion, which is the third largest single period of investment activity in Canadian history. There was also greater selectivity in where capital went as investors looked to protect themselves from the impact of the pandemic. Multifamily, industrial, and land assets saw increases in demand, while office, retail, and hotels were not as sought after. So let's consider the investment climate in Ottawa with two well-known deal makers who between the two of them have brokered the sale of most of Ottawa's skyline. Nathan Smith is the Executive Vice President and Managing Director of Cushman & Wakefield in Ottawa, and Nico Gentile is Senior Vice President of Capital Markets and National Investment Team member for CBRE in Ottawa. So Nathan, I'm going to open with you. What are you seeing as it pertains to Ottawa's investment profile as it relates to commercial real estate?
Thanks very much, Sean, and appreciate being invited to speak. So it's interesting because pre-pandemic, Ottawa was like most of the country, quite frankly, most of the West, was hitting on all cylinders. The market was strong. Cap rates were continuing to compress, and deals were happening at a pretty significant rate. Ottawa's liquidity was about $2 billion a year, a little over that in some bigger years. We saw a significant impact with COVID, and surprisingly, our numbers dropped only to about $1.7 billion. So maybe a 20 or so percent decrease, or 25% decrease. If you look at the country overall, the country was down about 21%, but the hardest hit asset was our biggest asset class, which was office. It was off about 55%. So a significant difference there. And, you know, I guess filling the gap was industrial and significant activity with land and anything multi-res. So as asset classes, you know, as we got into the pandemic, it was a pause. Everybody kind of said, whoa, we're not sure what we need to do or what we can do. And then as you said, as we got deeper into 2020, we saw activity pick up as people got their footing, but it was mostly industrial, multi-res, and significant positions in land for multi-res.
Gotcha. And Nico, on your end, are you seeing Ottawa continue to do well in certain asset classes as this pandemic, really hit, or is Ottawa rising above and showing some strength?
No, I think very much so. I mean, I think COVID was a blunt force instrument for sure, but I think if you look at Ottawa in the context of the national scale, it really is kind of the great equalizer market, right? When the rest of the country is experiencing periods of tremendous growth and acceleration, Ottawa helps to, bring things back to base level, and vice versa. When the rest of the country is not doing so well, Ottawa, helps to sort of prop things up. So it's a rising tides lifts all boats theory, but I think like anything, it's pockets of strength, pockets of weakness. I think we have the fortunate position where we have a stability factor that exists in Ottawa that, fortunately for us, unfortunately for others across the country, it doesn't exist in those same markets. So given the propensity of federal government, workers in this city, the stability that comes with that, and that overwhelming presence does provide a level of stability and security that allows it to punch above its weight class, notwithstanding some of the greater macro market volatility. So we've always done well and have been insulated against a lot of the sort of macro market volatility. We do get hit like everybody, but I think we've stood our ground really, really well.
So
Yeah,
you bring up
just to echo that, Sean.
Nathan, really, maybe give us, what are you seeing as the strong asset classes for Ottawa versus the not as strong? Is there anything that's particularly performing extremely strong and very desirable?
Is that question to Nathan or myself?
Well, it can be to either. I'll start with Nathan, and then Nico, you feel free to chime in.
So as I said earlier, industrial and multi-res are really the darlings of the market. They're there's been cap rate compression in both of those areas, irrespective of COVID, and land for multi-res. So we've, Nico and I have both traded an awful lot of density as far as land goes. We both have two office products in the market that are likely going to be converted to some form of res. It seems to be the market that has endured. Office market is difficult. Just you're not certain what's going to be. There's definitely going to be a work from home vacancy post-COVID. Is that 3% of inventory, 4, 5, 6% of inventory? So that market is struggling. And then obviously retail, interesting to talk about. Retail's been in flux for 15 years. It's been at the precipice for 15 years. And I think what COVID's done is it has really, set the stage for a rebirth of some of this retail product. Retail is going to really happen in the Amazon warehouses and in the logistics warehouses. And I think it's a rebirth. And, when you look at the major retail owners in the country, they've started a residential or a conversion to residential uses of their 20 acres of urban land all over the country. So again, industrial and multi-res good, office kind of in the middle, and retail having the biggest difficulty.
Nico, what are you seeing? Does that echo with you?
Yeah, I mean, at the risk of sounding repetitive in no particular order, I think that there are asset classes that, as Nathan mentioned, are continuing to perform really, really well. In some cases, better than they performed, prior to March 2020, and others that, are not as strong. And you would throw, retail in the mix for sure, and office, but within that office sector, there is a bifurcation of product that is still liquid, can still trade, with a focus on fundamentals, and there's aspects of the office market that are a little bit more challenging.
Yeah. So Nico, to you, who's buying in Ottawa? Like, what's the profile of a buyer like? And recognizing that's a large swath, but is the flow of capital into Ottawa a different form of capital that it might have been 10 or 20 years ago? And is there any significance to that?
Well, it's kind of like fashion, hopefully not bell bottoms, but it has in a way come full circle. I think we were a fragmented market at one point in time that got highly institutionalized over the last 20 years. And, we're now seeing the emergence of a stream of capital that's, pure play private equity coming back into the market. So in some degrees, that's complementary. In other areas, it's replacing, some institutions that are selling down or exiting the market altogether. But we've seen a number of publics that have taken, spots that have been vacated or voided by institutions and suburban office, as an example. But we've also seen, in terms of net new buyers come to the market, private equity groups that are looking for relative value in this market as they're being priced out of other more expensive markets like Vancouver, Toronto, Montreal. And I think in general, as an overarching statement, real estate as a hard asset strategy, I think is proven in 08, 09, and again in March 2020, is not as subjected to the same volatility that you see in equities markets or infrastructure, or, et cetera. And so I think that as a hard asset class strategy, that has resonated with a lot of private equity that we're seeing come from other asset classes into real estate.
Nathan, are we a hot market or a stable market, or are we a hot market because we're a stable market?
I think the latter. So Ottawa, as Nico said earlier, is counter-cyclical. We are the home of government. The federal government occupies almost 60% of our downtown office inventory, which currently has no people in it right now. But basically, it's the strength of the federal government and the programs that they commence, counter-cyclical to the economy, that help maintain Ottawa's stability. We don't sell Ottawa as a growth market. Growth is a secondary component of our market. We sell it as a stable market. And as Nico said earlier, when you look at your portfolio across the country in times of disruption, you basically see Ottawa as stability. It's not fancy that, we don't have those big spikes of growth, but we're a stable market, and it's the strength of the federal government that keeps us stable. So to answer the question, I think we're a hot market for investors because of our stability, more than anything else. And just to echo on Nico's conversation about private equity, Sean, it's a real renaissance for private equity. So, just about everything we brought to the market really before COVID in the last 3 or 4 years, we've had multiple bids from all kinds of private equity, from regional private equity, from national and from U.S. private equity. And it's a testament to the strength of large capitals of private equity. But more importantly, is the larger, the top tier of the market, the OMERs and the larger institutions that have left some of the Canadian markets to invest broadly globally, it frees up that opportunity, and everybody kind of moves up a rung on the investment scale, and it gives private equity an opportunity to compete. And especially now, when you look at historic low interest rates, even though the bond market's moved in the last 3 weeks, the 10-year bond has moved back to somewhere that, a little closer to pre-COVID. The positive equity, the positive leverage available in the market today for the private guy is unbelievable. So it's a real renaissance and a real opportunity for them to continue to deploy capital.
So on that point, and Nico, to you, we're talking bond rates, and certainly the spread of cap, or the spread between, between cap rate and bond rates. Where does interest rates come into this, and is that a risk, an opportunity, or do we not see interest rates fluctuating at all in the short to medium term and not having an influence on the investment market?
No, I think it has a big influence. I mean, as Nathan said earlier, certainly on the private equity side, but I mean, institutions are levered players as well. So the 10 years moved, the 5-year hasn't moved as much, but if you're looking at a spread over a 5-year bond right now, you're talking about all-in rates for a good product in the low twos, 2 to sort of 2.25. So implicitly when we talk about that, we think, okay, what does that mean? Well, if you talk about a cap rate, for instance, being a risk-adjusted spread over fixed income and positive leverage, I guess, and not too many buyers love to hear this, but it does open the door that we can see additional cap rate compression in certain asset classes, and I think we've seen it. And primarily, if we talk about what the Bank of Canada's doing, what the Fed's doing, I think they've, we don't have a crystal ball. It's hard to see where interest rates are going to be, where bond yields are going to be in 3 years. But I think there has been a coordinated effort, certainly from the Fed, to say, we want to keep interest rates down, for the foreseeable future. Now, that's not 5-10 years from now, but certainly in the next 1 to 2 years, we're not anticipating any big spikes in interest rates. And I think correspondingly, it's going to keep it pretty buoyant in terms of liquidity.
Okay. We've just down to about 2.5 minutes remaining. So I'll just ask you both a question, just a final question, starting with Nathan. What would you tell to somebody who was looking to invest in Ottawa on why they should invest in Ottawa? And you can choose the asset class. Let's assume it's a desirable one, like industrial or multi-res, but what's the sales pitch for Ottawa?
So there's the sales pitch for Ottawa is always the same. So currently there's 150,000 people on the government payroll, but you have to realize that there's 150,000 behind them that are still collecting government wages in the retirement. It's a super strong retail market, one of the best in the country. It's a strong residential market. And from a stability standpoint, the effect of the federal government and our burgeoning technology industry really gives you a broad base of strong economic factors to invest in Ottawa. Again, we don't sell growth, we sell stability, and it's really the pitch for Ottawa.
And Nico, a flip of the same coin, what would you tell somebody on why it's a good time to divest of an asset right now? And again, assuming it's a positive class of asset, but what's the not sales pitch, but what are the motivating factors that someone might want to consider selling?
Yeah, so unselfishly, I think, it's an interesting question. Why would you want to sell today? I think the obvious answer is because the market, for certain asset classes is very liquid. And if you want to realize a return and redeploy that into another market for whatever reason, whether it's domestically or internationally, that coincides to your investment strategy, then I think now is as good of a time as any, under those sort of caveats in terms of asset classes. If the hope is you want to go replace that in an equal asset and equal market, I think it's difficult to do. So I'm not sure that would be the best advice. But I think that, certainly for all the reasons we talked about today, fundamentally, it is as good of a time as any to liquidate. But it's not broad stroke brushing, the entire real estate market. There there are pockets of strength for sure, and there are also pockets of weakness with some challenges.
Yeah. Okay. Gents, we're out of time right now. I'm grateful for your time. That was very interesting. And again, thank you for explaining it in terms that I can understand, recognizing that of all the asset classes, the investment world is the most esoteric with, with all of the financial elements. So thank you for keeping it high level
Thank
so
you.
I can understand. But I'm grateful for you walking us through that. Thank you.
Great.
Thanks, Sean.
Thank you. Bye, Nathan. Bye, Sean.
Take care.
I hope you enjoyed and found something useful from today's presentation. I want to thank all of our experts for both their commitment to today's presentation and especially for sharing their experience with all of us. Our thanks again to our co-sponsor, the Ottawa Board of Trade, and to the Property Management Institute of Canada for helping us put this together. Watch for more BOMA presentations in the months to come. And again, our thanks for joining us today.